All right, let's talk about bear markets and whether we are currently in a bear market. This is a term that's used in stocks: bear market, bull market. Bear market is down, bull market is up, is basically the gist of it. 2022 has certainly been a bad year for the stock market, and we are currently considered to be in bear market territory. Bear market means a drop of greater than 20% in the major indices. 10% is considered a correction, and we can even put this up. If you have a situation where you are down 10%, this is considered correction territory. And minus 20% is the big, ugly, scary bear market. Okay, let's look at some historical bear markets. And you see some that should be familiar to you. The Great Depression, down 83% at its peak, lasted 783 days. We had the World War II bear market. We had the Vietnam War bear market, the oil shock bear market in the mid 70s, a high inflation rate raising bear market in the early 80s. The dot-com bubble was another bear market, financial crisis of the late 2000s. The COVID pandemic bear market, which, as you might remember, and we talked about it in another video, ended very, very quickly. And then the current bear market, it has been 161 days since the peak as of, actually, it's been longer. This data is a couple months old. We were, at the time of the writing of this chart, it was down 21.8%. We had high inflation, and the Fed was raising rates. Oftentimes, these can be self-fulfilling prophecies and feedback loops of a sense. Stocks will slide into a bear market from a correction as investors worry that economic conditions will continue to slow, which will then reduce corporate profits, which then will reduce the value of the stock of those companies. So there is absolutely a circular nature to this. Now, one of the things that's important to consider for this current bear market that we are seeing right now are the causes. And the ones that are sort of officially listed are, number one, we have supply chain issues affecting some industries. Number two, of course, inflation. This has been a topic of significant discussion and political significance. Three, Fed raising rates. Now, one of the things you might say is, well, wait a second, why would the Fed raise rates if that's bad for the stock market? We talked about this in our inflation and mortgage rate segment. The idea of the Fed raising rates is to slow down inflation. And the idea is basically as follows. If the federal funds rate goes up, federal funds, then what we would call other rates also go up. And this can include mortgage rates, which we've talked about. This can include other loan rates and rates on loans for businesses to expand. This, of course, will put decreased pressure on pricing. And then the idea is that it'll deal with inflation. Of course, it tends to not be very good for the stock market. And this is why it's often said that when the Fed raises rates, you want to do it in balance and you want to do it in a way that doesn't take too much momentum away from markets. There's another question here, in addition to the bear market, which I think bears mentioning, which is about a recession. Now, a recession would be 2 quarters of declining GDP, 2 consecutive quarters of declining GDP, and we have had that. Now, I've said before, we're definitely in a bear market. I don't know that we're really in a recession. And one of the things that makes me think we are not is that employment is so strong. The country is essentially at full employment. And also, part of the reason that we had the second of 2 quarters of declining GDP, and it was barely, I believe it was like 0.9% or something like that, was a reduction in inventories in many businesses, which counts against GDP, and a decrease in government spending on certain programs. And so it's a very borderline case. It was barely a second consecutive quarter of the decline, And the reasons why are very narrow, and they don't necessarily signal broader economic concerns. Now, I'm not making any prediction. This is not a political channel, and I am simply evaluating what I see. You can have recessions without bear markets and bear markets without recessions. In fact, if we go back to our image here, if you look at the in 87, for example, there was a significant decline in the market. There were actually a number of significant declines in the market. I believe this is the one we're talking about here, right where you see the listed ones are only the biggest bear markets, but every vertical blue line is a bear market. If you look between 85 and 90, there's a small decline there. That was a 34% decline in the market, but it was not a recession. And then if you look at 1966, and then you look at 62, which was before that, you look at 1947, these are all declines. They were bear markets, but they did not have a recession. More often than not, they do happen together. So if you look at 2020, if you look at 2008, if you look at the dot-com bubble, those were bear markets alongside recessions. In terms of what to do based on this information, my advice is don't do anything. If you've seen my video on timing the market, you already know that we are terrible at figuring out where these bottoms are. If you look at the dot-com bubble, you had this cresting peak and then decline. And at the time, you had people doing so-called technical analysis saying it's going to go down, down, down further. And it didn't, and it went up. So number one, I would not try to time this in any way. The average bear market lasts 9 to 16 months. We're about 10 months into the current bear market. Could go longer, could be over every single day. What you have hopefully been doing is continuing to buy all along and lowering your cost basis. So let's take a look at what that looks like. And we did sort of an example of this. Let's see if I can put together a chart here. Like this. Okay. So we had, a bunch of periods of stocks going up, and then we've had these declines, all these different declines. They go all over the place. This is time, and this is the price. What I have been doing is I just keep buying. And remember, I often use red to signify when I buy. Look, I bought some at the peak. Oh, no. Well, but I also bought down here, and I bought down here, and I bought down here and here. So at this point, my average price is the average of all these points. Well, as stocks decline, am I waiting for the bottom? No. I mean, I might have thought this was the bottom. I might have thought that was the bottom. I would keep making mistakes. So what I do is I buy, and then I buy, and then I buy, and buy, and buy, and buy, and buy. And what ends up happening is that thanks to this entire period, thanks to all these purchases that I make monthly, what ends up happening is, imagine that my average price at this point was like right here. This was my average price at time T1. What happens is that by continuing to buy lower and lower and lower, at time, call it T2, my average price that I've paid is all the way down to here. It doesn't really matter, just as an example, right? So this is my T2 price. And this was my T1 price. I now have lowered my cost basis. And so if I believe that eventually stocks are going to start going up, right? Let's just say they go up, whatever. At time 3, which is here, because I have this lower cost basis, thanks to continuing to buy, my profit, we'll call it little p profit, is this. Whereas someone who did not buy on the way down would end up with this price as a cost basis. That line was really bad. Let's see if I can draw it straight. This price, right? Which price would you rather when stocks are at this level? Would you rather this or this? Well, it's clear to me. I'd rather have this amount of profit than only this amount. Makes perfect sense to me. Okay, so the point is, bear market, just keep buying.